Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Frederick, Managing Director of Trading Derivatives at the Schwab Center for Financial Research, to discuss technical levels in the Nasdaq 100 as investors turn their attention to the debt ceiling. We'll also touch on Home Depot earnings and retail sales. Randy, it's great to see you as always. Welcome back to Trade Talks. I want to get your thoughts around the debt ceiling. It doesn't feel as if the market is quite as worried about it as I would have expected it to be.
Well, the market's not worried about it. I think you're right now. And I think part of the reason for that is that we have at least a minimum of about 2 weeks before it becomes a problem. And I actually think probably longer than that. As you know, Janet Yellen's been talking about June 1st as the earliest possible date that we might hit the ceiling. The Congressional Budget Office, on the other hand, is forecasting something more like 3, 4, 5 weeks out past that. Volatility gauges tend to not get really worried until you get close to that date. Now, if you look out at something like the volatility skew, the S&P 500 skew, it's at a 13-month high. So there's definitely a lot of hedging going on. And then secondly, if you look at things like VIX futures term structure, you see a pretty sharp ramp up and then a flattening out around the August-September timeframe. So both of those gauges are showing that the concern just not in the very immediate term.
And let's also talk about Home Depot earnings and what we're seeing with retail sales. Home Depot having its first revenue miss in a number of years. Do you think that is a sign of consumer health overall?
Yeah, to some degree it could be. Here's the interesting thing about the retail data. There's a lot of conflicting data going on in retail. There are some wholesale home builder supply companies that are hitting record high levels right now, whereas Home Depot, which of course has a big contractor unit, is not. And they're struggling. Like you said, they had some pretty weak earnings and weak guidance. We'll have to wait and see if Lowe's follows suit. Those two don't always work perfectly. Sometimes they do. We got a retail sales report this morning. As you know, it was the first uptick since January, but at the same time, it also came in slightly lower than expectations. So we have a lot of conflicting data going on in retail. So it's very difficult to know exactly what's going on there. And it may be just a matter of the whole segment not moving together. You may have to be a little bit picky, pick and choose individual names within that group.
Right. And that's kind of always been the case with retail, right? The haves and the have-nots could be the discounters, it could be the department stores, ones that they're going to be doing well, or the other one isn't. So to your point, it could be, idiosyncratic to one company and perhaps not a macro indication for the consumer. Let's switch gears and talk about technicals for a moment as we look at the Nasdaq 100, because of course, those mega cap names that have such a high weighting in the index have really been with propelling the market, or at least keeping, putting some support in the market.
Yeah, the Nasdaq 100 is really knocking it out of the ballpark. It's the only major index out of all of them that's in a bull market now. It's well up over 20%. It's up something like 23% year to date. But as you said, it's driven a lot by the big mega cap, mostly tech type names that have done exceedingly well this year. I mean, Apple and Microsoft alone make up about 20% of that index. Both of them are up over 30%. And in fact, if you look at 8 of the top 10 holdings in that index, they're all up over 30%. A couple of them are up even 100% year to date. So it's hard for it not to do extremely well given the weighting. But as I said, it's definitely outperforming all the others.
Right. But then of course, you have concentration risk, right? You don't want it to become a market as goes those stocks, goes the market.
Yeah, I mean, there's always a lot of concern about the fact that, the rally doesn't have good breadth and that it's not broad-based enough. But the reality is these names sometimes are bigger than the next 20 or 30 stocks combined. So, and in fact, if you talk to most investors have some allocation to some of these big names because they're names of companies that we all interact with on a daily basis in some form or other. So it's okay. I mean, unless you're entirely concentrated in just one name, even if you're spread out across just a handful of these. And the other thing that's fascinating about some of these names is that we think of them often as tech names, and many of them are actually either consumer discretionary or consumer communication services. They're just sort of tech names in our own minds, but they don't actually fall into the tech sector when you do that breakdown.
All great points. Appreciate the insight as always, Randy. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.